Faster, higher, stronger. That's the official motto of the Olympic Games. And on the evidence of the last 20 years, it also applies to the host nation's stock markets. In the calendar year after each of the last 5 games, the stock market of the host country has outperformed the world average by at least 2 to 1. In some cases, more than 3 to 1. James Bevan, director at fund managers CCLA, explains why.
I think that the key issue, of course, is that not only is there significant investment in the economy, but also sentiment towards the economy, to the market and to the general outlook is much improved when you have a domestic success.
Let's start with Barcelona in 1992. The following year, world stocks rose 22%. Spain's IBEX jumped 54%. In 1997, the year after the Atlanta Games, world stocks rose 13%. The S&P, it gained 31%. 2001, following the Sydney Games, was a bad year for markets. The MSCI World Index fell 17%. Yet Australia's All Ordinaries rose 6.5%. Greece outperformed world stocks almost 4 to 1 in 2005, the year after the Athens Games. Did China's Shanghai Composite match the 32% global market surge in 2009? You bet it did, and then some, up 80%. So, Britain's FTSE has a pretty tough act to follow next year.
I find it very difficult to anticipate that London can deliver a multiple of returns of other markets, but I do think it is relatively well placed given that we have a very flexible approach adopted by the Bank of England, we have relatively low valuations and we have a defensive profile of companies, which I suspect is appropriate given the prospects of continued slow growth.
However, the hurdles are manifold and high. Britain is in recession and any recovery will be anemic. The government's severe austerity programme has yet to be fully felt. And the country's banking system is large relative to the size of the economy. And what's more, it's broken. And of course, there's the small matter of the Eurozone crisis, right on Britain's doorstep. Jamie McGeever for Reuters.